The big question is, why does Brazil need such an absurdly high interest rate while countries like the United States can function with much lower rates? To understand this, we first need to understand what an interest rate actually is. An interest rate is essentially the price of money. When interest rates are low, borrowing is cheap and people are encouraged to spend and invest. When interest rates are high, borrowing becomes expensive, consumption slows down, and economic growth is restrained. Central banks use interest rates mainly to control inflation, stabilize the currency, and manage the pace of economic growth. In Brazil, the main interest rate is called the Selic rate, and it is set by the Central Bank of Brazil. In the United States, the equivalent is the federal funds rate, controlled by the Federal Reserve. The most important reason Brazil has such high interest rates is inflation, especially Brazil's long and painful history with inflation. Brazil did not just experience inflation in the past, it experienced hyperinflation. During the 80s and early 1990s, prices in Brazil could double in a matter of months. People rushed to spend their money as fast as possible because holding cash meant losing purchasing power almost immediately. Salaries were constantly adjusted, contracts were indexed, and saving money made no sense. This period destroyed trust in the currency and deeply shaped the economic behavior of the country. Even though inflation was finally brought under control in the mid-1990s with the Real Plan, the memory of hyperinflation never disappeared. Because of that, policymakers, investors, and consumers in Brazil are extremely sensitive to any sign that inflation might return. As a result, interest rates in Brazil function as a defensive weapon. The central bank reacts aggressively to inflationary pressures because letting inflation escape control would be economically and socially disastrous. High interest rates reduce consumption, slow down credit growth, and help keep inflation in check. At the same time, they help protect the Brazilian currency. Brazil is far more vulnerable to capital flight than developed economies. If interest rates fall too much, investors may move their money elsewhere, the currency can depreciate rapidly, imports become more expensive, and inflation rises again. This creates a dangerous cycle that the central bank is constantly trying to avoid. This is where the comparison with the United States becomes very clear. The US dollar is the world's reserve currency. It is used in global trade, international reserves, and financial markets all over the world. Because of that, the United States does not need to defend its currency in the same way Brazil does. When global uncertainty rises, investors often move money into US assets, not away from them. Brazil, as an emerging market, does not have that privilege. It must offer high interest rates to attract and keep capital. Another major factor behind Brazil's high interest rates is government debt and fiscal risk.